Hello, everyone. I'm Ted Oakley, managing partner at Oxbow, and I'm really happy to have back my friend today, Michael Belkin, that writes the Belkin Report. And Michael, I think you've been around for what, 30 something years? How many years?
33 years, Belkin Report.
33 years. And I know you've had some of the best calls. I've obviously had your stuff for a long time, your research, and I would recommend it to anybody, but made some of the best calls there is. But I might just set this up by saying that we had you back on November 13th, and almost everything that you discussed happened. A lot of things you moved around. You know, you had bonds, you knew when to sell those. You had oil, you knew when to sell those. But tell me how you think about things right now. We're starting with the markets.
Okay, well, it's a very kind introduction considering I'm completely wrong today. It's got to be one of my worst days in quite a while. So the short-term outlook for the stock market is insanely overdone, just ridiculously. So I have this major reversal indicator for the NASDAQ, S&P, European stock indexes, everything. And it's a proprietary reversal indicator that I've had for quite a while, but we're moving further and further into insanity. So it's basically how far you can stretch a rubber band before it breaks or it snaps back down the other way. And right now we're at really, really extreme measures. So it's conventional measures like daily RSIs, like 90 something for the NASDAQ. So that's another way of looking at it. That's not my proprietary reversal indicator. So what's happened is also the long-term forecast is down. So just let me take a step back and remind your viewers, and if nobody's ever heard of me before, what do? I have a proprietary time series forecasting model. It's based on my studies at UC Berkeley Business School and Statistics Department at Berkeley. I fine-tuned it at Salomon Brothers when I was there in the late 80s, early 90s. And basically, what does the model do? It gives three things: direction, position, and intensity in a 12-period forward forecast. So it's not looking at in the rearview mirror. It's looking what's supposed to happen next. Okay, so direction, up, down, or neutral, position, beginning, middle, end, and intensity or confidence interval. Direction, position, intensity. Okay, so the long term, let's focus on that for a second. The long-term focus for forecast for the NASDAQ, S&P, Russell, European indexes, everything, everywhere, is down. And these long-term forecasts do not set up very often. And that's probably of the most concern to obviously long-term investors. If you're a short-term trader, that's another thing. This is not for short-term traders, but this looks like a major, major long-term top. Okay, similar to, say, the way it looked in late 2007, 2008, before the S&P went down 56%, or back in March 2000 at the top of the tech bubble. So this is a situation that's similar to those. I don't like overlaying charts with other charts and expecting the same exact thing, but it's just it's a speculative bubble. We had a huge stimulus fueled speculative bubble, from COVID, and we're basically operating on the fumes from that, even though the Fed has been doing QT for quite a while now. So the long-term forecast is down, and the model doesn't give a exact level. It only gives direction, position, intensity. So what I use is trend analysis, long-term moving averages, and those moving averages are way, way below. So intermediate term, the 200-week average for the NASDAQ is down more than 25% at this point. And the 200-month average, which is where long-term speculative bubbles tend to bottom, not right away, but over a period of months or years, is down more than 50%. It's like 60% for the NASDAQ, 50% for the S&P. So that's a long-term view. And then combination of the long-term view being down and the short-term view being stretched like a rubber band, ready to break. I think this is a very, very dangerous market. So that's the best I can give you, best summary of the way the model sees the market currently.
And Michael, let me ask you this. Have you ever seen news chasing at a level like we've had the last 12 months, Effective since November.
No, so I don't know if that's algos, off of news headlines. I must say, our president, I don't want to get into politics here, but he's absolutely been masterful at manipulating people's sentiments about the stock market, and he's obviously focused on it very closely. And he's jerking people around, like a puppet master, and he's so you can't say that without saying what is the difference between what people are thinking and what is the reality. Okay, so what is a tariff? A tariff is a tax. Like, let's not call it a tariff, let's call it a tax. So what does a tax do? It makes the price of something go up and the quantity of something go down. Get out your old, macro, supply and demand curves. So what do we have? We have a massive tax increase on imports, also on exports, because people are, foreign countries are responding. So in no way is that bullish for the economy. So just from a fundamental economic perspective, what lies ahead is higher prices and less quantities of goods that people have grown to depend on, depending on what you do, tires, or people that shop at Walmart, or just things you buy on Amazon. So there's like a huge sigh of relief today. So if you put this in perspective, so what happened today, 145% tariffs on China were reduced to 30%. And that is good news. Okay, yeah, it's sort of good news. It's not, thank God it's not 145% anymore, but it's 30%. I'd hate to be a importer or something and trying to figure out what to do when the story changes every day. So the reason I go into that soliloquy about what is the difference between the economic reality of what is happening and the way it's being spun, and like you said, the news headlines impacting people's psychology and willingness to buy stocks. So my report last week showed retail investors have just had the highest buying of ETFs and individual stocks of all time, massively. That ended, though, by the way, it'll probably be back up today, but that ended, a week or two ago, about 10 days ago. So anyways, there's been this huge, I think, disconnect between what people are thinking by being manipulated by the headlines and what is really taking place or is about to take place.
You get the impression, Michael, that people after the last 15 years just think generally, okay, that the market can't go down a lot.
Absolutely. So it's been since 2009, S&P went down 56, 57%, and people were around. So I remember I gave a presentation at the CFA Society of Seattle right before that, and it was entitled Light at the End of the Tunnel. So I'd been correctly short all the way down, telling people to sell. And then I said, I could see in the model forecast coming that there was a turning point coming, and it was going to be a great buying opportunity. So everybody in the room, these are all portfolio managers, RIAs, family offices and stuff in Seattle. And they were glad to hear this, but they didn't have any money. They've been demolished. But yeah. A number of people said that to me afterwards in comments, well, it's great news. It's too bad I don't have anything to invest. Because so if you've lived through a downturn like that, and been punished, you kind of learned your lesson. So my point in saying that is, it's been whatever, 15 something years since then. And the generation of traders and investors that have grown up since then have not experienced anything like that. So they see every dip as a buying opportunity, blah, blah, blah. And so I think they may begin about to learn things the hard way, as those attendees at the CFA Society in Seattle did back before the bottom in 2009.
Well, it's interesting because, we at Oxbow, we get a lot of heat because we carry a very high position in short-term treasuries. And my point to people is that if you don't have some liquidity during tough times, you're stuck. You can't do anything. And they fail to realize that now in particular. But that's one of the things I was going to ask you was, and I keep talking about this, but the baby boomers are fully in this market. And I mean, really, really into this market. And they don't seem to be afraid of anything.
You're absolutely right. So I have some anecdotal evidence on that. Uh, so JP Morgan, back before the 29 crash, when the market was already beginning to trade down, he went to a shoe shine. He went to a shoe shine guy every few days, and the shoe shine guy wanted to invest with him. And he said, "We've got me and the other shoe shine boys know you're a great investor, and what we pulled a bunch of money and we want to give it to you." So JP Morgan went back to his bank and he sold everything. And he said, "If the shoe shine boys are buying, there's nobody left to buy." So that's a really classic, anecdote. So, anyways, a couple of weeks ago. I went outside. My gardener, my neighbor's gardener, not ours, a delightful woman. We get along well with her, but she drives an old beat up truck, old beat up lawnmower, and she's clipping stuff for them. And she says, "Oh, the market's down so much. I'm really worried." So to me, that was like similar to the shoe shine boy, JP Morgan. If the gardeners who are driving beat up trucks have their life savings in the stock market and they're worried about it, what have we come to?
Well, and you mentioned that in your last letter that they've really bought into it. They put their life savings in it. I mean, pension plan, their personal accounts. And I think the term you used that stock investing has institutionalized, I believe you said, a surefire approach.
Yes, unfortunately, the idea. So it infected all the way down to my son. I got this notice on my email this morning. Robinhood is requesting $300. So my son has got this automatic Robinhood thing where he hardly makes any money. He's managing he recently graduated college. He's managing a mountain biking program here on the island where I live outside of Seattle. But I try to explain to him, the danger that this is, or he says, "Oh, but you just keep putting money in and it will work out. This is for my retirement. I don't need it right away." Yeah. So that mentality it's gone all the way down into my family.
Well, I'm going to ask you a couple of questions about your letter. And by the way, we get your research. It's excellent. And I know it goes to so many big names that people wouldn't know this, but overseas, family offices, big pension funds, they watch what your strategy goes. But I'm going to ask you a couple of special things. One of the things, I'll take gold mining, for example, gold and gold mining, for example, for first. And, the big question is going to be, is it over? Because everybody keeps, they've been looking for a time when it would correct. But do you think it's over? I know you have at the top buy. You did have. I don't know if you still have.
Absolutely. So I'm glad you brought that topic up. So there's a critical event coming up in 6 weeks. And let me explain. So while the retail markets are focused on price, central banks are focused on tonnage. So it's extremely important to understand, effective July 1st, in 6 weeks of 2025, gold will become a tier 1 asset under the BIS Basel III rules. This is huge, and nobody's talking about this. You have to really dig to find out about this.
So you mean because I own part of a bank. So a bank under Basel the Basel new regs, they could own it like they own a treasury.
Absolutely. And it's only physical gold, so not paper gold.
Yeah, physical.
Not ETFs, not gold stocks,
right.
Physical gold only. And I think this is going to be a huge positive influence. So already, what has been driving the physical gold rally? It's been Chinese central bank buying, other central bank buying, right? There's speculators, and if you look at the commitments of traders, it's kind of high, but that always happens when the gold price is going up. But this is something, I think this is a completely earth-shattering, regime-changing, absolute for gold. So central banks, now you're an individual bank, but this is a central bank. So basically, Indonesia, Malaysia, Sweden, Switzerland, this, instead of having dollars or gold or whatever, or treasuries or Chinese treasuries or anything, physical gold becomes a tier 1 asset. So I think this is going to ignite I don't think instantly out of, it's not like a horse race where they come charging out of the gate, but it's going to keep the gold rally going and increase it. So, and you have to think about this, have a historical perspective on this. So what was gold? Gold was the reserve asset, before Bretton Woods, going back, 100 years or so to the, when central banks began being developed. Gold was it was there, it wasn't somebody else's liability. It was safe. So it was something that you could put your reserves in and know that they wouldn't be taken away from you, or, wouldn't default, whatever, on somebody's debt. So we're back, we're going back in that direction. And this is hugely positive for the physical gold price. So I see this sell-off today, which we're having, certainly in gold stocks, as a huge buying opportunity. Maybe, when the dust settles in a day or two, I think this is a time where you want to be buying physical gold. And gold shares have lagged gold. And getting back to the model forecast, so that's just the fundamental outlook for gold. The strongest long-term sector group forecast versus the S&P that I have is for XAU index. So I follow a lot of my work. It has to do with sector rotation and group and stock selection, long ideas, short ideas, generating alpha by avoiding losses in stocks that are going to underperform and finding alpha in stocks that are going to outperform.
Now, you might mention what the XAU is just for the listeners. I know, but we just so.
Okay, so I use the XAU index because it's been around the longest. So there are other gold bug indexes and GDX and all these other things. So the XAU has been around for a long time, 20, 30 years. So for monthly data, so remember what the model is: direction, position, intensity. So I sat down here yesterday looking at all the sectors, utilities, staples, tech, communication services, industrials, financials, et cetera. Relative to the index. So a ratio of the sector relative to the index, what's going to do the best for the next 12 months? XAU comes out on top by a mile. Direction up, intensity strong, position early. So gold stocks have lagged, and I think so the long term, so today they're certainly getting whacked short term along, with, being short the market is certainly hurting, or saying that's, being against, thinking the market's going to top out. It looks like a stupid call today. The long term is a completely different story. So the long term is down for stock indexes, and for the ratio of the XAU gold stock index to S&P is up, and that's relative, and it's also up absolute. So that's the only sector that's like that. The other sectors that have long-term outperform forecast are utilities and staples, and those are up in relative terms, but not in absolute terms.
I think you call those chicken longs.
Yeah, so fall less than the market. So. Yeah. Anyways, that's the overall. So you asked me about gold. I'm way bullish. I think there's a huge fundamental event coming in 6 weeks' time that will continue to supercharge the physical gold rally, and that will drag all the other, gold stocks and et cetera, silver and silver stocks and everything up along with it.
Now, you recently added some of the Bitcoin stocks, and you hadn't had them on there for a long time, and so you added them. Is that a 12-month forecast too?
No, that's a 3-month view. So, so just to give you an idea, the model likes to buy low and sell high, right? That's what you're supposed to do. That's like Warren Buffett, buy.
Yeah.
So the model is looking for inflection points, and a lot of it is relative. So again, back to the idea of ratios, what sector is going to do well. So the model had been short Bitcoin stocks, physical Bitcoin, and Ethereum, okay, which is another cryptocurrency. It's kind of the second largest market cap one, I think. And the model changed 2 weeks ago. This is an example. The model is not a broken clock. The Belkin report is not a broken clock. It changes when things set up. So just to give you an idea what happened, Ethereum, which was really depressed, it was down 60%. It was up 28% last week. And it's up another 8 or 10% today, last time I looked. So there are opportunities. That was a buy low opportunity. And then there's a number of Bitcoin mining stocks. And these are kind of not the highest quality stocks you're going to find. But so they use computers to use the algorithm to mine Bitcoin.
I want to ask you about the things you don't like. And I think if you've stayed on this Mag 7, but Tell me things you dislike the most.
Okay, so I have to start that with the sectors. So sector forecast this weekend, certainly not working today, but communication services, a recently defined sector by Standard & Poor's, is number one. Tech is number two. These are monthly, long-term down. Financials, a little bit. That they look like they're topping. So that's very controversial. European banks are extremely overowned and in the stratosphere. So I have a short signal on European banks, which is extremely contrarian. I don't see anybody else saying that. I don't see everybody else's stuff. But and then healthcare is new. Okay, so healthcare has been neutral for a month or two. It's usually a defensive sector that outperforms. And then Trump has come out with this decreased drug price thing for Medicare program. And all of a sudden, these major drug stocks are underperformed short candidates in the model forecast. So that's Merck, Pfizer, all those big, Lilly, all those kind of names. Those are fresh as of this week underperformed forecast.
When you talk about the communication being number one, who is in that group for you?
That's Google, Alphabet. So Alphabet is actually the largest cap stock. So they split it into two. There's A shares and B shares, whatever they call it. And together, that's the largest cap stock. They keep saying these trillions. Apple is 2 trillion, 3 trillion, whatever. Alphabet by itself is if you combine the two, it's the largest cap stock, and that's the biggest component of the communication services. After that, it's Meta. So those two, and let me tie this into a fundamental view. So the model tells what markets are looking for an excuse to do before they do it. It doesn't know why. It's not a why thing. It's something about the time series analysis. There's a cyclical component of what's going on, and what the model does is help my clients explain the sector rotation that doesn't make sense to them. So a lot of times my clients are individual stock, guys, and they have some stock, and it's all of a sudden the sector that it's in is underperforming the market, or they're short a stock and the sector is outperforming the market. So the model helps to explain some of that volatility. So anyways, communication services. So the model gives the looking for an excuse idea. Then you need a catalyst, right? So what is the catalyst for communication services? It's advertising. So these guys are just basically advertising platforms. Meta, I think it's 98% of their income and revenue comes from advertising. And it's a similar amount for Google. And so what goes down in a recession? Advertising. So it's like a discretionary expense that gets cut. So I think there's been a huge amount of extraneous advertising, shall we say, on platforms like Facebook and Instagram, which is Meta, of course. So I think these guys have both an excuse. The model has it say they're looking for an excuse to go down, and they also have a catalyst in the form of what is going to happen to the economy. Again, going back to what we talked about originally, what are tariffs going to do? They're going to cause a recession ultimately. And so we've had this front loading, right? So everybody and his brother have been buying stuff. So it looks like, inventories have gone up slightly, and there's been, purchases have been moved forward on the retail end by individual consumers because they're worried stuff isn't going to be there or the price is going to be up. So everybody knows that. So, that process is going to run out in a month or two. And if we get back to the idea of efficient markets, efficient markets are supposed to reflect all available information. And the information, I don't think at the moment they are reflecting what's going to happen once this front loading, wears out, and all of a sudden we have a slowdown in retail sales, inventories are run down, prices go up. We have the worst of all possible worlds. We have an increase in inflation and a decrease in demand.
Well, and on that sell list, I think one of your top sells is NVIDIA, talking about this AI craze and everything.
Absolutely. So NVIDIA is still the number one buy of individual investors. in the stuff that I've been seeing from
Mhm.
brokers. I get this sort of secondhand, from Morgan Stanley, Goldman, JP Morgan. So that's the stock, even though it's down before today, it's down about 25% from its peak. So if we go back to what happened, February 19th was the peak in the NASDAQ and the S&P, I believe. And also most of these tech stocks, and NVIDIA actually topped out on the first or second trading session of the year. So back at the beginning of January, and it's been down. And so they keep buying it. And it reminds me of these ceremonies that you have like in Latin American countries where they walk down the street whipping themselves, and so the stock keeps going down and they keep buying more and more of it. So let me just flesh that out a little bit. So the NASDAQ is still down 7% from its February 19th peak. And so we've had, so what do we have? We have the first sharp sell-off based on words. So Trump says, he holds up the board saying we're going to have 50, 60, 100% tariffs on everybody. Stock market freaks out, trades down. Then, so he freaks out, pulls that, says, okay, we're not going to do that anymore. The stock market starts bouncing back. It's been bouncing back ever since then. So far it's been on words only, right? So the actual impact of the tariff is only beginning to hit. Oh, by the way, little diversion there. I live in Seattle, and when I take the ferry in, this is one of the primary ports on the West Coast, and there are no shipping containers and no ships. Like usually, I have a boat and we go out to this island south of here, Blake Island. They're usually container ships stacked up all the way out to there across across Puget Sound. There's nothing. There's no ships. No. Usually there's shipping containers stacked in the port. So that's like not happening. So anyways, that is about to hit. So the NASDAQ is still down 7% after today, and the S&P is still down 6%. So we've had this exaggerated bounce based on words, and yet, so it's all words so far, but the real world effect is about to hit. And even after this so-called reduction from 145% to 30% tariffs, there's still going to be a big problem with the economy. And by the way, tech is the most exposed sector to foreign sales, right? That's the biggest one. So they are the most vulnerable to counter tariffs. And I don't know, I'm no big expert on this, but I think that so they're certainly looking. Europe is certainly looking at these companies: Google, Microsoft, Apple, and Meta, Alphabet, and coming up with these, multi-billion-dollar charges and restrictions and all these kind of things. So yeah, I think big tech is vulnerable. It's still top of my list as a short.
Yeah. And a question, on that what you're talking about, but would you agree that tariffs are worse on the country that imposes them than they are on the country that gets imposed upon in the long run?
Good question. So China is in big trouble right now. So that's a good segue into talking about China. So I don't know if you remember, but beginning of the year, China, I got to buy China. I need more China in my portfolio, just like I need more NVIDIA in my portfolio. So China turned out to be a disaster, right? So these tariffs have hit the profit margins were never very large for these Chinese production companies, that sell to Costco and Walmart. And all of a sudden, it's been a disaster. So they're laying off people. So I'd say it's a mixed bag to answer your question. It's been very hard on China. The effect has hit them sooner than here because the orders get canceled, the ships aren't. So that effect is there's a lag between the way it has affected China and the way it's going to hit the U.S., which is still arriving or not arriving because the ships aren't arriving. So I think ultimately there are going to be shortages, and just like everybody, just like a lot of everybody, I say most people, I have been front-loading purchases of things like brakes for my car. Auto parts are a big problem, right? Tires that are made overseas in Japan or Korea. It's not just China. Also European, Michelin, things like that. The prices are going to go way up and the availability is going to go down. So I think we're set, there's an old saying, the lifestyle that you ordered is out of stock. I think there's going to be a shock like that hits a lot of US consumers who have grown used to this, this ability, this abundance of cheap foreign goods. That's been our lifestyle in this country, for decades now. And all of a sudden there's a real kind of, Trump has put a certainly roadblock to that whole idea.
Michael, we always include in this down below where people can see during the call, we always include how to get in touch with you and get the Belkin report. And you do, a lot of your report goes to big family offices, big funds, things like that. But the question I would probably wrap up with is this. If you had to say something to the individual investor today, and particularly over 55, let's say, what would be your advice for them today in general?
Sell everything. Sell the all your NASDAQ, all those kind of stocks. Raise as much cash as possible. Buy gold stocks. I do a separate gold stock report. I cover all the individual investable gold stocks that trade in the U.S., Canada, London, Johannesburg, in Australia and China. I think those are a buy low opportunity. For a trade, I like cryptocurrencies for a trade, especially Ethereum. So it's not something that probably most people look at, but I'm not a Luddite. I follow cryptocurrencies. I was short them. Now the model is long them. That's for a trade. That's not a long-term trade. But I think there will be opportunities to trade the bear market. I think we are in a bear market that started February 19th. Okay, this has been a bear market rally, and this is an incredible opportunity to get out of long equity exposure. Thank you, POTUS, for creating this opportunity, this gift selling opportunity. And so, if you are extremely conservative, I would just be in cash. So, by the way, we didn't even talk about bonds. I'm short bond. The model has been short bonds for about a month or more.
And you were long. You were long bonds from really in a good period right there for about 4 or 5 months. It was that you made money in them.
Yeah. So again, it's not a broken clock. Bonds were a good trade. Now I think there's a big problem, and the dollar. Again, if we go back to what's going to happen with central bank Basel requirements, I think the dollar was going to remain out of fashion. And although we're having a bounce today, along with everything else, so I think gold, physical gold stocks, short-term treasuries, like you mentioned, not long bonds. I think long bonds are a short at the moment for a trade, and they remain a short. And cryptocurrencies for maybe 2 to 3 month view. And that's about it. I think if you're in a bear market and the long-term forecast is down, you want to avoid losses. So that should be your primary concern. Avoid loss.
What do you, and people don't know this about you, but I know this about you. I've seen you make some great calls just in the last 3 years, as a matter of fact, not just over the time that I've read all of your research. You've made some good calls just in the last 3 years. But right now, you're fairly alone in that call of the market breaking. And maybe that's a good thing. But, because everybody thinks, oh, it's all over now. We're headed to new highs this year by the end of the year. Do you see it that way? People talking about it like that?
The short-term traders, yes. But so the cover story in last week, Barron's, not this week, was how bearish portfolio managers are because the market is overvalued. So pros like me that have been around for decades have seen this movie before. And so there's been this short-term pushing by short-term traders who've probably only been in the market, for the last 15 years when there's never been an extended bear market. So there's kind of this tug of war, bulls versus bears. And I think, the positioning went up, so the if you look at National Association of Investment Managers data, they got squeezed back in on the way up. So I think it's a very difficult environment. People that have been around for a long time know it's a bubble, know stocks are overvalued, know the economy is going to hit a cliff soon. And yet the individual investors keep pushing things back up, and POTUS keeps dangling, stories to make people want to buy stocks. So it's a complicated environment, I think it will shake out to the detriment of short-term traders. Certainly not happening today, but I'm standing my ground here.
But also, Michael, if you look at people, say from the mid 40s down in age that are in this industry, okay, they've never seen anything particularly bad. So I think that'll be the hardest group, and they're out there managing money. But I don't think they understand the game when you get into tough times.
You're absolutely right, and I have seen this over. So my first clients, when I first started out, so I left Solomon beginning of 1992. My first clients were what I called the hedge fund mafia, and I have over the years I have seen the big funds hire young hotshot traders, and they get tested by fire in downturns. So certainly I think what happened in this downturn, in this recent downturn, places like Citadel, they leveraged up in to buy the dip, and those are probably they have pods of traders, right, who trade different stocks. So I assume, I don't have any direct knowledge about this, but I assume what happened is they say, oh boy, it's a buying opportunity, let's buy. So right now, that theme has run its course. The young hotshot traders who have never seen an extended downturn are loaded back up, probably, with some of the stocks that sold off and have bounced back. But I think the bad news is going to hit. It's going to continue. What is going to drive the market down? It's going to be earnings. Okay, so this earnings season was not too bad, right? But the expectations going forward are ridiculous. Almost double digit for the rest of the year. If the economy turns down the way I suspect and forecast, then corporate earnings are going to come in as a huge disappointment and probably decline. And that is what will drive stocks down. And these young hotshot traders will probably learn that the hard way.
Well, Michael, I can't thank you enough. Always interesting, and you always have the most interesting comments. And I would recommend people to go look at your letter. I've obviously seen it for decades, but it's a one of a kind for sure. But listen, thank you for being with us. Hopefully we can see you next year.
Thank you so much for having me, Ted.
All right, Michael, thank you. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.